Welcome, curious minds. Today we're diving deep into a fascinating and absolutely critical area of finance. We're talking about the intricate world of accounting and taxation for derivatives.
That's right. It sounds complex and, well, it can be, but understanding it is crucial.
Our source material for this deep dive is a comprehensive chapter you share with us, focusing specifically on the Indian regulatory landscape.
Uh-huh.
Our mission, to really demystify how these complex financial instruments, everything from forward contracts to equity index and stock futures and options, are meticulously accounted for.
And just as importantly, the significant tax implications that surround them will be pulling out the most important nuggets, focusing not just on what the rules are, but really why they matter for anyone engaging with these tools.
Yeah, think of it as your shortcut to being genuinely well-informed on a cornerstone of modern finance, without getting, bogged down in every single granular detail.
Exactly, a practical understanding.
Okay, let's unpack this and get started on understanding the precise rules governing these powerful financial tools. Let's maybe begin with forward contracts. They sort of lay some foundational understanding for derivatives, right? How are they accounted for, especially when their purpose might differ?
That's a great place to start, because the purpose, as you said, is absolutely fundamental here. Under Accounting Standard 11 in India, there are two really distinct accounting treatments. It's largely driven by whether the forward contract is intended for hedging or, for outright trading and speculation.
Okay, so two paths depending on intent. How does hedging work?
Right, so for hedging, imagine you're using a forward contract to, say, lock in a future exchange rate. You want to shield yourself from currency swings.
Mm.
In this scenario, any initial premium or discount, that's basically the difference between today's spot price and the future agreed price, it isn't recognized immediately as a gain or loss.
Ah, okay, so it's not instant P&L impact?
No, exactly. Instead, it's spread out or amortized over the entire life of the contract. Now, any exchange rate difference that crops up by the settlement date or even a reporting date like year-end compared to its previous valuation, that goes straight into your profit and loss statement for that year.
Got it. And cancellations.
Yep. And if you cancel or renew the contract early, any resulting profit or loss also hits your P&L in that period. Straightforward enough for hedging.
Okay, so what about the other side? Trading or speculation?
Right. Now, if that same forward contract is used for trading or speculation, the accounting approach shifts, well, entirely. You don't amortize any premium or discount.
No spreading it out.
Nope. Instead, any gain or loss from the contract's changing value. So the difference between the forward rate you originally booked and the current market rate for its remaining maturity that gets recognized immediately in your P&L for that period.
Right away. Okay.
And the rule for cancellation or renewal, it remains similar. Any profit or loss from those actions is recognized in the P&L of the year they happen.
So the intent behind entering the contract fundamentally changes how it's treated on the books. That distinction, just based on purpose, is really critical, isn't it?
Yeah.
And it sets the stage perfectly for understanding how futures, our next topic, bring in that even more dynamic element with daily adjustments.
Exactly. Futures involve that daily mark-to-market, which needs a different approach on the books.
Okay, let's shift focus then. Equity index and equity stock futures. The Institute of Chartered Accountants of India, the ICAI, gives specific guidance for clients. How does the accounting even begin for these contracts?
Right. At the very start, at inception, the key accounting action revolves around the initial margin. When you enter a futures contract, you pay an initial margin to your broker or the clearing member. Now, think of this not as buying the contract itself, but more like providing a security deposit.
Okay, it's like good faith money.
Precisely. This amount is recorded by debiting a specific initial margin account for equity futures. It basically shows cash moving into its dedicated holding place. If you have to pay additional margins later, they're handled similarly debited to that account. But what's crucial is that no actual accounting entry is made for the futures contract itself at this point, only for the margin you've paid.
Interesting. So the contract value isn't on the books yet. What about the balance sheet?
Good question. At the end of a financial period, any balance sitting in this initial margin account is shown separately. Under current assets on your balance sheet, it acknowledges it's essentially your deposit held by someone else. And if you happen to have paid more than the required margin, that excess amount is also disclosed as a separate deposit, still under current assets.
And what if you use guarantees instead of cash?
Ah, right. If you've provided bank guarantees or maybe lodged securities instead of cash for margin, that usually only requires a disclosure. In the notes to your financial statements, There's typically no actual accounting entry for the value of those lodged securities themselves in this context. So when Mr. X pays, say, RS 50,000 initial margin, it's debit initial margin equity futures account, credit bank account, simple transfer.
That makes perfect sense. The initial margin is a safety net, a deposit, not the cost of the contract. Given that, here's where it gets really interesting for me. How do the constant daily price movements of these contracts actually get reflected in the books?
That's precisely where mark-to-market or MTM margins come in. Futures contracts, as you know, are settled daily based on price movements. This means any payments you make or receive because of these daily price fluctuations are recorded. They get recorded by adjusting a mark-to-market margin account.
So a separate account just for the daily ups and downs.
Exactly. This account acts as a running tally of your daily gains and losses on the open positions. You can even maintain separate MTM accounts for different indices or stocks if you want clearer tracking. These daily payments or receipts usually flow through your bank account or maybe from a deposit account held specifically for MTM with your clearing member.
And at year end, if there's money in that MTM deposit account.
Right. At year end, any remaining balance in a specific deposit for mark-to-market margin account is also shown as a deposit under current assets. It's quite a clever system, isn't it? Designed to manage risk and keep things transparent on a daily basis.
It really is. So the MTM margin account captures the daily flow.
Mm-hmm.
But what happens to any open contracts when the financial year closes? This must be where prudence comes in.
This is a really, really important point for any open contracts at the balance sheet date because, as you said, it strictly applies the prudence principle in accounting, the net balance in your mark-to-market margin account that reflects all those net payments or receipts due to price movements right up to that date.
Okay, so what does prudence dictate here?
Here's the key distinction. If that balance indicates an anticipated loss, meaning prices have moved against your position, and you have a net debit balance in that MTM account, then a provision for that loss must be created.
Must, even if it hasn't settled.
Yes, must. This means you immediately debit your profit and loss account to recognize that potential loss, even though the contract hasn't actually settled yet. This provision is then shown as a deduction from your mark-to-market margin account, which itself sits under current assets, loans, and advances. It's a conservative approach, you see, designed to prevent overstating your assets and to manage risk proactively.
Okay, recognize losses early. What about potential profits?
That's the other side of prudence. If the MTM balance indicates an anticipated profit, so a net credit balance because prices moved in your favor, that amount is essentially ignored for year-end P&L accounting.
Ignored, you don't book the gain.
Nope. You take no credit for it in your P&L until the contract is actually settled or closed out. That credit balance, which indicates a profit, is instead shown as a current liability under current liabilities and provisions. It's basically funds held by the clearing member that are technically yours, but you can't book it as income just yet.
Wow. So potential losses hit the books immediately, but you can't count your paper profits until they're real.
Exactly. And this provision for loss, it's calculated on a stock or index-wise basis, combining all the contracts you hold in that particular series. So for example, if Mr. A pays RS 5,000 as MTM margin reflecting a loss, the entry is debit profit and loss account, credit provision for loss on equity futures account.
That's a crucial application of the prudence principle. Recognize potential losses, but definitely not unrealized gains. This must influence how traders manage positions near year-end, right?
Absolutely. It forces a realistic assessment and can definitely influence closing decisions.
Okay, so what happens when a contract is finally settled, or maybe closed out early, squared up?
Right. At final settlement, or when you square up a contract, which just means entering an opposing position to close your existing one out, the actual profit or loss is calculated. This is simply the difference between the final settlement price and the original contract price, considering all contracts in that series. This calculated profit or loss is then directly recognized in your P&L account.
Finally hitting the P&L.
Yes. With a corresponding adjustment, a debit or credit to your mark-to-market margin account to basically zero it out for that position. And if you're squaring up multiple contracts of the same series bought or sold at different times, you typically use a weighted average method to figure out the cost basis for calculating this final profit or loss.
Makes sense. And the initial margin.
Crucially, upon settlement or squaring up, that initial margin you paid right at the start is released back to you. So you'd see an entry like debit bank account or deposit for initial margin account, credit initial margin account. So bottom line, if you made a profit, it's debit M2M margin account, credit P&L account. If a loss, debit P&L account, credit M2M margin account.
Okay, clear enough. And what if, unfortunately, a client defaults on their margin payments? How does that get handled on the books?
Yeah, defaults happen. In that scenario, the contract is immediately closed out by the exchange or clearinghouse. Any unpaid amount the client owes is then adjusted against their initial margin deposit. If there's any excess margin left after covering the dues, it's released back to the client. If there's a shortfall, well, the client still owes that amount.
And the profit or loss on that forced closure?
The accounting treatment for the profit or loss on that specific closed-out contract, it remains the same as we just discussed for a normal settlement or squaring up. It still hits the P&L.
Right. That provides a pretty comprehensive picture for futures. What about disclosure requirements? What do clients need to show in their financial statements?
Transparency is key, as always with derivatives. The important disclosures include things like the amount of any bank guarantees provided, and the book value and market value of any securities you might have lodged as margin for outstanding contracts at the year-end. This needs to be broken down by the type of instrument.
Okay. What else?
Additionally, you need to disclose the number of open futures contracts you hold. That includes the number of contracts and the number of underlying units they pertain to, as of the balance sheet date. And this needs to be separated out clearly for both long positions and short positions, and also detailed by each specific index or stock. It's all about giving a clear picture of your derivative exposure.
Got it. Full transparency on open positions. Okay, let's switch gears now and explore options. How does their accounting differ from futures, starting right from inception?
Right, options. While there are definitely similarities, options introduce a key difference right from the get-go: the premium. At the inception of a cash-settled option contract, the seller, or the writer, pays an initial margin. That part is similar to futures. It gets debited to an equity index stock option margin account and shown under current assets.
Okay, seller pays margin. What about the buyer?
The buyer, or the holder of the option, pays the premium. This premium is essentially the price or cost of buying the option right itself. For the buyer, this premium paid is debited to an equity index stock option premium account. And for the seller, that same premium they received is credited to their equity index stock option premium account. So unlike futures where there's no initial cost beyond margin, here there's an immediate cash exchange representing the value or price of the option contract itself.
I see. So the premium is a distinct element from the very start for options, acting as the immediate cost for the buyer or income for the seller. What about the daily margin movements? Are they similar to futures for the options seller?
Yes, for the seller, the margin accounting for options is quite similar to futures. Any payments they make or receive for margin adjustments are handled through their bank account and that equity index stock option margin account. And if they deposit a larger sum, as a lump sum for margin purposes, it goes into a deposit for margin account, which also shows up under current assets at year-end. So the flow of funds for margin calls and releases for the seller largely mirrors what we discussed for futures. The buyer, of course, doesn't typically deal with ongoing margin calls, just the initial premium payment.
Right. Buyer pays up front. Okay, so how are open options treated at the balance sheet date? Especially considering that premium paid or received. The prudence principle must be in play here too, I imagine.
Absolutely. Prudence is critical again for open options at year-end. That equity index stock option premium account we mentioned, it will be shown as either a current asset for the buyer or a current liability for the seller. If you have multiple options, you can use a single composite account, but generally tracking it stock or index-wise is advisable, especially for calculating any necessary provisions.
Okay, so let's break that down. What does prudence mean for the buyer at year-end?
Right, for the buyer or holder. If the premium you originally paid for the option is now more than the option's current market value, its prevailing premium at the balance sheet date, this indicates a potential loss if you were to close it out right then. In this case, a provision for that unrealized loss must be made. This provision essentially allows for reducing the potential loss by hypothetically squaring off the position.
So again, recognize the potential loss. What if the option's value went up?
But if the prevailing premium is higher than what you paid, indicating an anticipated profit for you, the buyer, consistent with prudence, that gain is not recognized. Not yet. The provision for loss, when needed, is recorded by crediting a provision for loss on equity index stock option account. And this provision is then shown as a deduction from your equity index stock option premium account, which is under current assets.
Okay, buyer recognizes potential loss, ignores potential gain. What about the seller?
Now, for the seller or writer, If the option's prevailing premium at the balance sheet date is higher than the premium they originally received, it means they have a potential loss if the option were exercised against them or if they had to buy it back. In this case, a provision for that potential loss must be made. Conversely, if the premium the seller received is still higher than the current prevailing premium, indicating an anticipated profit for them. Again, prudence dictates that gain is not recognized yet.
Same principle, different side of the trade.
Exactly. This provision for loss for the seller is credited to their provision for loss on equity index stock option account, with a corresponding debit hitting their P&L immediately. Both the equity index stock options premium account, representing for premium originally received, and the provision account are then shown together under current liabilities and provisions. And if you have multiple open options at year-end, you look at it stock-wise or index-wise, a net loss across all bought or sold positions under that specific stock index gets provided for. Any net gain is ignored. It ensures a conservative view.
That's quite detailed, but it really clarifies the different treatment for buyer and seller and how prudence consistently applies recognize likely losses, defer likely gains. Are there any specific scenarios where this distinction, especially with prudence, leads to unexpected challenges or maybe complexities for either the buyer or seller?
Well, it primarily impacts how you present your financial health at year-end. For a buyer, not recognizing an anticipated profit means your balance sheet might look less robust than your actual market position suggests, which can be a bit frustrating. For the seller, having to immediately recognize a potential loss, even if that option ultimately expires worthless later, really highlights the continuous risk management involved. It compels businesses to be very realistic about their contingent liabilities.
So constant vigilance needed.
Yes. This constant reevaluation of open positions means continuous monitoring. And if it's not handled correctly, it could lead to unexpected hits to reported profitability if the market moves sharply against you near the reporting date.
Thanks for clarifying that potential impact. Okay, what about when options finally reach their settlement date? Or maybe they get squared off beforehand?
Right, at final settlement. The buyer or holder will recognize the premium they originally paid as an expense in their P&L account. That initial cost hits the P&L now. If the option is actually exercised, any favorable difference, like the final settlement price being higher than the strike price for a call option, is recognized as income. For the seller or writer, the premium they initially received is now recognized as income in their P&L. But if the option is exercised against them, any adverse difference for them is recognized as a loss. And once an option is exercised or expires, any margin the seller had paid for it is released back, credited to their equity index stock option margin account with a debit to their bank account.
Okay, and squaring off early.
For squaring off before expiry, it's simpler. The difference between the premium you paid, if you were buying to close a short position, and the premium you received, if you were selling to close a long position, on those squared-off transactions is transferred directly to your P&L account. Profit or loss is realized immediately. And the accounting for releasing the margin money for the seller is similar to what we just discussed for final settlement. Also, like with futures, if clients have multiple outstanding options of the exact same stock index, strike price, and expiry date, a weighted average method is typically used to calculate the profit or loss when squaring off parts of that position.
We've mostly been talking about cash-settled options. What happens if the option involves physical delivery of shares? That must add another layer.
It adds a crucial final step, yeah. But thankfully, the initial accounting for these delivery-settled options at inception for margin payments or receipts for the seller, and for handling open options at the balance sheet date, it largely mirrors the process for cash-settled options we just covered. And if a delivery-settled option just expires unexercised, the accounting is also identical to cash-settled ones. Premium hits P&L, margin released.
So the complexity is only if it's exercised.
Exactly. The key difference comes if the option is exercised, because this is where actual shares have to change hands for cash at the agreed strike price. So for a buyer exercising a call option, for instance, they debit the relevant equity shares account, getting the shares, and credit their cash or bank account, paying for them. For a seller having a call option exercised against them, they'd credit their equity shares account, giving up the shares, and debit their cash bank, receiving the payment. It's the reverse for put options, of course.
Right, the actual share transfer.
Yes. And importantly, in addition to these share transfer entries, the premium that was originally paid by the buyer or received by the seller is still transferred to the P&L account, just like with cash-settled options. The entries mirror that, so it's essentially the cash-settled counting framework plus the added step for the actual share movement on exercise.
Okay, it's good to know that delivery settled largely mirrors cash settled. just with that extra share transfer piece. What about general disclosures for options, similar to futures?
Pretty similar, yes. Important disclosures include outlining your accounting policies and methods specifically adopted for equity index stock options, things like your recognition criteria, measurement basis, need to be clear. You also need to disclose the amount of any bank guarantees or the book value and market value of any securities lodged for outstanding options at year-end, particularly if initial margin was provided that way. And finally, both the buyer holder and the seller writer must provide detailed information on their outstanding option contracts at the year-end. For each equity index stock option, it's all about ensuring complete transparency of the open positions.
Makes sense. Transparency is crucial. Okay, we've done a really deep dive into the accounting side. Now let's turn our attention to the equally critical tax implications. How are profits and losses from derivatives transactions typically taxed in India?
Right, the tax side. In India, generally speaking, gains or losses that arise from derivative transactions carried out on recognized exchanges are treated as business income or loss. This means they are typically taxable under the head profits and gains from business or profession.
Okay, business income. Now, this raises an important question. Historically, I think derivative transactions were viewed a bit differently, perhaps with some skepticism. Are all derivative transactions still treated the same for tax purposes today, or has that evolved?
That's a great question, and this is where the historical context is really insightful. And yes, it represents a massive game changer. You're right. Prior to the financial year 2005-06, derivative transactions were specifically classified as speculative transactions under Section 43(5) of the Income Tax Act.
Speculative. Why was that?
The reasoning was because settlement was considered otherwise than by actual delivery of the underlying asset. It was seen as more akin to betting on price movements, and this classification had a significant negative impact for traders. Any losses from these so-called speculative transactions could only be set off against other speculative income.
Definitely speculative income. That sounds restrictive.
It was very restrictive. If you didn't have enough speculative income in that year, those derivative losses couldn't be used to offset your regular business income or other income heads. This often led to a higher overall tax liability, even if you had losses.
Ouch. Okay, so what changed?
Here's where it got really interesting, as you hinted. The Finance Act, 2005, brought about a fundamental amendment to that very Section 43(5). It explicitly excluded eligible derivative transactions, specifically those carried out on a recognized stock exchange, from being defined as speculative.
Ah, so exchange-traded derivatives got carved out.
Exactly. This was huge. As a result, income or loss from derivative transactions conducted on a recognized exchange is now taxed as non-speculative business income or loss.
Non-speculative. What does that mean practically for loss set-offs?
It means the rules for setting off and carrying forward losses became much, much more flexible and favorable. Losses from these non-speculative derivative trades can now be set off against any other income you have in the same year. Well, with the standard exception of salary income, you can't set business losses against salary. But you can set it off against other business income, interest income, etc.
That's a big difference. And carry forward.
Yes, and if you can't fully offset your derivative losses in the current year, they can be carried forward for up to 8 assessment years. And in those subsequent years, they can be set off against any other non-speculative business income you might have then. This fundamentally changes the game for risk management and tax planning for derivative traders.
Definitely. Any catches?
Just one main condition. The right to carry forward these unabsorbed losses is conditional on filing your income tax return on or before the due date. So timely filing is crucial. And as a bit of a bonus, the securities transaction tax, or STT, that you pay on these derivative transactions, that's eligible as a deductible business expense under the Income Tax Act, 1961.
Okay, STT is deductible. That's good to know. So a huge favorable change for domestic traders back in 2005. But what about foreign portfolio investors, FPIs? Do they follow these same business income rules?
No, FPIs are treated differently. They have a distinctly separate treatment under the Indian tax laws. For foreign portfolio investors, any gains or losses they make from derivative transactions on a recognized stock exchange in India are typically taxable under the head capital gains.
Capital gains, not business income.
Correct. And since most derivative contracts that FPIs typically engage in have relatively short maturities, usually maturing within, say, 3 months, these gains or losses are generally classified and taxed as short-term capital gains or losses. This reflects their specific regulatory framework as foreign entities investing in Indian markets, rather than conducting ongoing business operations in the same way a domestic entity might.
Interesting distinction. Okay, so given all this, let's think about an individual trader in India. What does this mean for someone looking to perhaps simplify their tax filing for futures and options trading?
Well, for smaller traders, there's a potentially beneficial option called presumptive taxation, which falls under Section 44AD of the Income Tax Act. If your total turnover from F&O trading doesn't exceed the threshold, which is currently Rs 2 crores, you can opt for this presumptive scheme instead of the normal business income calculation.
Presumptive scheme, how does that work?
Under the scheme, your taxable income from F&O is simply assessed at a prescribed flat rate, currently 6% of your total turnover from that activity. The big advantage is simplicity. You don't need to maintain detailed books of accounts for expenses or worry about claiming individual tax deductions for trading-related costs. It's designed to really simplify compliance for smaller volume traders.
6% of turnover, that could be attractive, but it's an option, right?
Yes, it's optional. You can choose the normal scheme, calculating actual profit loss, or the presumptive scheme if your turnover is within the limit.
Okay. And what about the dreaded tax audit? When does that become mandatory for derivative traders? That seems like a big concern for many people.
It certainly is a key consideration, yeah. And whether a tax audit under Section 44AB is mandatory depends primarily on two factors: your turnover and your declared profitability. An audit is definitely mandatory in a few specific cases. First, if your total turnover from derivatives trading exceeds Rs 10 crore in a financial year, then regardless of whether you made a profit or loss, an audit is required under Section 44AB.
Over 10 crore, audit needed. Okay. What else triggers it?
Secondly, if your turnover is between Rs 2 crore and Rs 10 crore, and you have not opted for that presumptive taxation scheme we just discussed, and your declared net profit from F&O is less than 6% of your turnover, then a tax audit becomes mandatory as well.
So if you're in that middle band, don't use presumptive and show low profits, you need an audit.
Correct. The logic is if you're claiming profits lower than the presumptive rate, the tax authorities want a formal audit to verify it.
Are there scenarios where an audit isn't required then?
Yes, definitely. If your F&O turnover is below Rs 2 crore and you choose to declare profits of at least 6% or more of your turnover under the presumptive scheme, Section 44AD, then no tax audit is needed. Also, there's other provision. If your turnover is between Rs 2 crore and Rs 10 crore, and more than 95% of your total receipts and payments related to your business, including F&O, are done through digital modes like banking channels, then a tax audit isn't necessary regardless of your profit or loss percentage. This promotes digital transactions.
All right, the digital transaction incentive. That gives a very clear picture of the tax audit landscape. Thank you. Finally, let's touch upon the Securities Transaction Tax, or STT. We mentioned it's deductible. What exactly is it, and how does it apply specifically to derivatives?
Right, STT. It stands for Securities Transaction Tax, and it's basically a direct tax levied on the value of transactions done on recognized stock exchanges in India. It applies to the purchase and sale of various securities, including equities, derivatives, futures and options, and equity-oriented mutual funds. It's not something you pay separately. The exchange collects this tax directly from the broker, who collects it from the client, and then the exchange remits it to the government. It's built into the transaction cost.
Okay, collected automatically. What are the rates for derivatives?
The STT rates for derivatives vary depending on the instrument and the type of transaction. For the sale of an option in securities, the rate is currently 0.10% calculated on the option premium value. This is payable by the seller.
0.10% on premium for selling an option. What about exercising?
Yes, if an option is exercised, the STT rate is 0.125% calculated on the settlement price. Strike price plus premium, effectively the intrinsic value settled. This higher rate is payable by the purchaser upon exercise. For the sale of a futures contract in securities, the STT is lower, currently 0.02%, calculated on the actual traded price of the futures contract. This is payable by the seller.
Lower for future sale and physical delivery.
Good point. For cases involving the physical delivery of shares, for example, when a delivery-settled stock option is exercised, the STT rate is 0.1%. This rate is payable by both the seller and the purchaser on the value of the delivered shares, similar to the STT on standard delivery-based equity transactions.
Okay, so STT is generally applied on the sell side for futures and options, unless exercised, and on both sides for physical delivery.
That's generally correct. STT applies on all sell transactions for both futures and option contracts. For futures, it's valued at the actual traded price. For options, it's valued on the premium. And as we noted, for the voluntary or final exercise of an in-the-money option, STT is levied on the settlement price on the day of exercise, payable by the buyer. The liability cascades up the clearing members. STT liability is the sum of all trading members clearing under them, and the trading members' liability is the aggregate of all clients trading through them. It's a key transaction cost to always factor into your trading calculations.
Wow, okay. That was a truly comprehensive deep dive into both the accounting and taxation of derivatives.
Oh,
Seriously thorough. We've really covered a lot of ground, from how forward contracts get treated differently based purely on their purpose, to the detailed mechanics of initial margins, mark-to-market settlements for futures, the premium accounting for options, and those crucial year-end prudence rules.
and we've definitely unpacked the critical tax implications too. Understanding that huge shift from speculative to non-speculative back in 2005 for exchange-traded derivatives in India, that's fundamental. Plus, how FPIs are taxed differently under capital gains, the rules around presumptive taxation for smaller traders, and when exactly a tax audit kicks in.
Yeah, and adding the breakdown of STT really highlights those direct, unavoidable costs involved in trading these instruments.
Absolutely.
So if you've followed along, you're now equipped with a much more robust understanding, I think, of the intricate financial and fiscal framework surrounding derivatives. We've moved beyond just knowing what they are to how they are precisely managed on the books and handled for tax purposes.
It really shows, doesn't it, that these financial instruments aren't just about predicting market movements. They're also very much about the detailed rules and regulations that govern their entire life cycle from the moment you enter a contract right through to its settlement or expiry. And understanding these rules is absolutely key, not just for compliance, but for actually optimizing your financial strategies.
That's a great point. And it raises an important question, I think, for you, our listener, to consider. How might understanding these specific accounting and tax treatments, the nitty-gritty we discussed, actually influence an investor's strategy? Think beyond simply forecasting market direction. How do the operational aspects, the compliance requirements, the timing of P&L recognition, the tax implications of losses? How do all these factors underpin successful trading or hedging? How can knowing these rules give you a significant edge in managing both your risk and your potential opportunities? Something to mull over.
Definitely food for thought.
Well, thanks for joining us for this deep dive. It was incredibly insightful. Until next time, keep exploring, keep questioning, and keep learning.